Okay, good morning, everyone, and you're very welcome to the second of our three results webinars for this round of reporting season. My name is Mark Clubb, and I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time this morning, you're very welcome, and for all our regular attendees, very welcome back. I'm just going to quickly run through some of these intro slides and then we're going to get straight into it with our first presenter. I would like to make a special mention to RAS Research as a Service, our sponsor for all our online events here at Coffee Microcaps. If you are looking for some institutional grade research on some smaller microcap names not kind of covered by the brokers, please do check out their website. Also, as always, very well welcome to ASIC. If you're joining us this morning, you're very welcome. For anybody who is joining us for the first time, the companies we tend to have on here, capped under 300 million, that's our definition of a microcap, in revenue and approaching cash flow break even, or indeed are already profitable, as are some of our presenters here this morning. We tend not to have companies from the resources and biotech sector, what I like to call industrial microcaps, which kind of encompasses everything else from tech, financial services, professional services, mining services even, and just that kind of everything outside of resources and biotech. Structure this morning's webinar, we've got 5 companies with here this morning, each going to get 30 minutes slot with, and we'll break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A function rather than the chat function in the nav bar. It just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and it'll be up on the Coffee Microcaps YouTube channel on Monday morning. And indeed, you can get our recording of last week's event up there as well, where we had another 5 microcap companies presenting their results. You can get us pretty much on all the socials. Twitter's our main one. YouTube, as I said, for the recording of this webinar and all our previous events, LinkedIn, and I do write a free monthly newsletter, which will also be coming out next week, which you can get on the Substack platform. Our first presenter, who we'll hand over to momentarily, delighted to be welcoming back Kate Quirke from Alcidion Group. After that, we are going to be joined by another returning presenter, Shaun Ankers from Energy One. Then delighted to be welcoming a new company to Coffee Microcaps here. Lucas Murtagh and Damian Smith from Asset Vision will be joining us. Then we'll be welcoming back Peter McGrath from Comms Group. And then finally, somebody you'll have seen presenting, I think, one of our in-person events along with Kate, Adam Cadwallader from Motio. They've both presented online and in person. So they're well known, I think, to most people. So I will stop sharing my screen and I'll hand you over to Kate. Kate, if you want to just bring yours up, I'll let you know. Yeah, I can see the cover slide now. Oh, we've just lost it there, Kate. If you want to bring it back up.
It's sharing according to mine.
Yeah, no, there it is now again.
Okay.
We have it. Okay, Kate, you can take it away whenever you're ready.
Tetchy technology.
Exactly.
Thanks very much, Mark, and thanks to you for the opportunity and to everyone for their attention. I haven't presented at Coffee Microcaps for a while, so I'm going to take the opportunity to give you an update on Alcidion, where we're at the moment, what we do, the problems that we solve, and then also a little bit about the financial results. We did our half-year results released last week. And the week prior to that, we signed the largest single contract that Alcidion has signed. And so I'll take you through a little bit of that and then give you time to ask questions. Better put my timer on so that I know how long I've been chatting for. So just a little bit, I'll just flick through the disclaimer and a little bit about where we're at. Anyone that's been following Alcidion will know we've been listed since 2016, did a number of acquisitions, some transformational acquisition back in 2018. And we've really been scaling the business to build to what it is today, which, I position it as a best-in-class healthcare data platform. and the data that we consolidate in healthcare into our product, Miya Precision, allows us to tackle some of the really challenging problems in healthcare today. And I'm going to talk about a couple of those specifically, although because we are a platform, a healthcare data platform, we can actually create many, many opportunities to address problems in healthcare through that consolidated data. So in summary, we're a healthcare systems software provider. We are based in Australia, but have offices and business and customers in Australia, New Zealand, and the United Kingdom. We've got about 100 plus implementations in Australia and beyond. And those contracts are generally long-term contracts. They might start at 3 to 5 years, but typical of the healthcare industry with software, they can run anywhere 10, 15, 20 plus years. And certainly we have got some contracts that have been in play for more than 10 years. We have a strong balance sheet, got about 150 million of forward booked revenue that comes from those long-term contracts. And we're continuing to execute on a very healthy pipeline, supported by a very experienced team in healthcare and very experienced in computer engineering and design and implementation. In terms of what we do with it, Miya Precision is what we call the platform. As I said, consolidates data from multiple healthcare systems. So it could be from pathology, pharmacy, medications, doctors' notes, primary care, mental health. All of that information can be consolidated into a single platform. It is cloud enabled. Obviously, the data is secure to that healthcare facility. We don't actually access the data. We just provide the platform that they utilize. And then what we do with that data is enable them to digitalize some of their clinical workflows, so make it easier for doctors and nurses to find the data and related to patient care, and have that presented to them on their mobile phones or in a manner that allows them to treat a patient at the bedside with the data that they need without having to go search for it. The consolidation of that data allows us then to create and provide a platform for the deployment of artificial intelligence. We've been using AI for some time in our platform, and obviously more recently with the introduction of large language LLMs and so forth, that we're starting to look at deploying those. But for many years we've been able to deploy algorithms in healthcare onto the data platform, and got a number of examples around how we've done that. It's real-time data, and it's really focused on integrating all the disparate systems of information in healthcare and bringing it to a central platform that can help doctors and nurses to deliver better care and healthcare systems to deliver more efficient care. The question is, why would we do that? Well, the opportunity is significant in healthcare, and anybody on this call that has needed to use the healthcare system will know that post-COVID, there has definitely struggled in relation to workforce challenges. But what we really are facing is increasing demand, particularly as the population ages. And there's an article in the Fin Review today talking exactly about the number of people over 65 that we're seeing increasing year on year as the baby boomers come through. They are going to have greater demand for healthcare services. We do not have enough healthcare beds and will not be able to build enough hospitals to support those. So we've got to be more efficient about how we manage the healthcare system. And so one of the use cases that we're seeing significant adoption of our platform for is to assist with what we call patient flow, or the moving of patients through the healthcare system, starting with how do we reduce ambulance ramping or bed block by getting patients discharged out of the system more quickly. What is holding them up? That opportunity exists pretty well worldwide and is increasing. In terms of this worldwide opportunity, we see the same headlines in the NHS in the UK, in Canada, in everywhere we go in respect of these challenges in healthcare. So it's not something that is unique to Australia, but we've been very successfully deploying our platform to support these challenges in Australia, New Zealand, and the UK. And I think we will continue to see significant demand for this, as this is a problem that is increasing, not diminishing. In terms of where we're really focused, as I said, healthcare platform, consolidating data available in the cloud, software as a service. And then what we've done is focus by building modules or capabilities from that data platform and selling those modules or making them available to our customers via an annualized subscription fee to tackle some of the really challenging issues. One of those is integrating the care record. So how do you bring all of this data together in a way that it makes it readily available and exposes it to clinicians? And we have a very significant project with the Australian Defence Force where we are working with a number of other providers, and our Miya Precision is consolidating the dental records, the mental health records, the primary care records, and even where appropriate, the hospital and emergency care delivery for all members of the Australian Defence Force. And that is going live very soon. So it's been a very exciting project we've been involved in for a couple of years now, and is a very large, long-term 20-year, sort of 5 + 5 + 5 year contract. We're very focused on digitising the clinical workflow, creating smart use of electronic noting, and starting obviously to look at these electronic scribes that are now emerging as a result of LLMs. We started our work in healthcare in focusing on releasing health system capacity. Patient flow is how we often refer to it. But ultimately what we're trying to do is get more capacity into the healthcare system through using technology to support it. And then another key area that we're focused on is how do we assist the healthcare system to treat more patients at home. And that is one of the real ways in which we're going to tackle this very significant challenge in relation to demand outstripping capacity, is to treat more patients at home or treat more aging people in their home rather than moving them into the healthcare system. And to do that, we use remote patient monitoring. Just to focus on a couple of those areas, releasing health system capacity, we have a number of contracts in place for our flow access command capability, which really is saying this is what is happening at any given point in time in a healthcare system. Here's the number of ambulances arriving. Here's what the emergency department looks like. Here's how many beds we have free. Here's the patients that might be able to go home if we tackle some of the things that they need before they get to go home, and creating that all almost into a command center like you would see, an air traffic control environment where they can see everything that is going on. We are creating that view so that people can run their healthcare systems more efficiently, and to create that capacity and releasing demand. Another area which has been very exciting for us, we began working with Royal Prince Alfred, or RPA Virtual Hospital, just before COVID. And obviously we accelerated quite quickly at that time in terms of being able to remotely monitor patients who had COVID, who were being maintained in either at home or in the hotel system as it was. And this allows us to use our platform in a similar way. Patients are at home, they've got devices such as these little eye health devices here, and they use those under instruction from an app on their phone that tells them how to take their oxygen sats or whatever. It depends what their care plan is and what condition they may be being monitored for, will determine what sort of devices are sent to their home. And then doctors and nurses are sitting in a centralised area. Sometimes they're doing visits out to the patient, but they can monitor these patients in their home regularly. They can contact them via the phone, have a video call if necessary. And our system is constantly surveilling the data and alerting doctors and nurses if anything is strange in respect to the information that they're receiving back from patients. And we see this as a significantly emerging opportunity for Alcidion, as more and more healthcare systems are looking to see how they can keep patients at home and away from having to come into hospital, and save those hospital beds for the really acutely ill individuals. So we have a number of deployments of our software across Australia, New Zealand and the United Kingdom doing exactly this, but also very much focused on that flow access and command center capability. in order to, continue to support the case that we make to healthcare systems for spending money on our technology as opposed to somebody else's, because obviously there are challenges in where they spend their money. We had an independent study done. The Alfred Hospital or Alfred Group of Hospitals deployed our solution around 2 years ago, and we did an independent study. Monash University conducted it with the Digital Health Consortium, and demonstrated significant reduction in length of stay, which is absolutely critical. Alfred's already a pretty efficient hospital, but being able to reduce that by a further 12% translates into real system capacity availability. And we then have done some work on how that translates into a benefits calculator and demonstrates to a customer that is looking to purchase our solution what money, it's not in true dollars, it's actually more about system capacity. What are they releasing in terms of capacity? So an 800-bed hospital that implemented the Miya Flow capability on Precision would release 321,000 nursing hours, 408,000 doctor physician hours, and over 27,000 hours of non-clinical time. So people who are cleaning and moving beds and moving people around. And the combined length of stay impact releases another 35,000 available days to have patients in beds, which is the equivalent to 97 beds, or the equivalent to about 300 hospital, three hospital wards. So, if you think about that, that's just one large hospital. How do you then calculate that across the whole system? Also, using our system, we're reducing paper. So we've eliminated 3 million paper documents in this deployment. And how does that then translate to financial benefit? So we have estimated for an 800-bed hospital implementing our system over in a year can release between $55 to $183 million worth of additional capacity, not to mention the trees that are saved by moving into a fully paperless environment. So that's really what Alcidion does and what we're focused on at the moment. Turning now, talking to a little bit about where we are from a financial perspective. This first half results were just released. For those of you who have been following Alcidion, you will know that we reset the cost base a little bit in the last 12 months off the back of, partly because of the Australian Defence Force project was very large, and we were funded to put in a lot of additional people on. But with the healthcare system coming out of COVID, we had scaled the business for increased capacity. And so we readjusted the cost base a little, and that's now demonstrating great benefit to us. We are committed to the fact that we will be EBITDA and cash flow positive for the full year, but for the half year, we also delivered a positive EBITDA result and a maiden EBITDA, both underlying but also made an EBITDA result. We had a significant number of new sales in terms of total contract value for the first half. Year to date, as we stand today, we've done over 61 million in new sales, which is the largest in any, and that's in TCV for the year. That's the highest TCV for the company, with still some months to go as the year transpires. And we currently stand at contracted revenue that will be delivered, able to be recognised for the year at 39.5 million, which is an increase on last year already, and obviously with some months still to run. So the financial results were very positive to the half, and certainly look to follow that through for the rest of the financial year. We always release this type of revenue dashboard that gives you an understanding about the pattern or how our revenue translates. I think what's important here, down in this bottom corner, you can see the dark blue bars is the increase in recurring revenue as a percentage of total revenue. We do and will always have some non-recurring revenue, because when you're implementing a health data platform, the customers also pay for us, our specialists, to implement the software. As we have shifted from one of the acquisitions we did was a very large services company, as we have shifted away from that services revenue into recurring product revenue and sold more and more of those long-term recurring contracts, we are delivering on our commitment to increase recurring revenue. Geographical split is generally around 50-50 for the full year. ANZ a little bit more for the half, but due to some significant contracts that we signed after the half year results, we'll see this perhaps move slightly in favour of the UK, representing a little bit more than 50% of the revenue for Alcidion for the year. We've had some notable contract wins year to date, and in all of these examples, the customers are buying Miya platform predominantly in the first instance to really look at that patient flow, hospital capacity management capability. We signed up the Hume Rural Health Alliance in Victoria, 16 hospitals over a wide geographical area, Albury, Wodonga and Wangaratta being the core sort of major centres, but they are then managing their bed flow across all their smaller hospitals. That was a 5-year contract. Over in Adelaide, we got our first contract in South Australia with Northern Adelaide doing a similar thing. Peninsula Health signed up as well, adding to the Alfred, Western Health and Hume as Victorian customers. And we got our first site in Wales, again, looking at that flow capability, but also the mobile capability. Hume is also deploying the remote patient monitoring or hospital in the home capability. So they'll be monitoring their patients that they are keeping at home using the Miya Precision platform. So really exciting outcomes. We had the week before last our largest contract to date signed, which was a contract with North Cumbria Integrated Care System in the UK. They are located in the north. It's a 10-year contract to deploy the Miya Precision platform and all our modules together help them to actually take their entire patient record and move it into a digital environment. That was a 10-year contract with rights to extend. Around the first 10 years is around 37.5 million, and that project has kicked off. So we'll be recognising around $8 million of that revenue in this financial year, and the rest will be recognised over the following years. And this is a really exciting opportunity for us in the NHS, where we're seeing significant investment in taking the records from paper into a digitised format, something in Australia we've actually been investing in fairly heavily for the last 15 years. So our opportunity in Australia is slightly different than it is in the UK, but it's still using exactly the same platform. Just the mix of modules that the customers may choose depends on where they are in their digital maturity. We have long-term customers, as I've touched on. Western Health and Northern Territory have been using Miya for over 10 years. I touched on Australian Defence Force and the RPA. So these represent customers that have, multi-year contracts with us. So one of the things about healthcare is it often takes you a while to bring the customers on board. These are enterprise type sales. They are multi-million-dollar type contracts. But when the customers are engaged, they tend to stay with you for a long time after they've made this investment to use your technology, particularly if you can demonstrate the sort of benefits that our platform has been able to prove through those studies like we did at the Alfred. So where to from here? As I said, strong contracted revenue for the year, guaranteeing that we will be EBITDA positive and cash flow positive. Oh, and there's a typo in my cash flow email there, in my headline there. We're got very strong momentum with a number of contracts having been signed in the last 12 months and continuing. One of the things about healthcare is people choosing to buy new solutions often look to evidence-based within the healthcare system, and we can now point to many studies and many reference sites that demonstrate the value that Miya Precision is bringing in healthcare. We have long-standing relationships and engagements with our customers and negligible churn that actually allows us to, maintain that strong recurring revenue base. And there are options for us to look at new geographies. So as we're continuing to execute very strongly in ANZ and the UK, but as I said, there are opportunities, and the problems we have in healthcare are worldwide. So looking to other markets like Canada, and like the Middle East and Saudi is definitely open to us, and something that we'll be exploring in the next 12 to 18 months. Strong cash balance. It was 7.7 million at the end of the half, but that's been strengthened already with the new contracts. And H2 is always a very strong period for us in terms of cash collections. So I'd like to leave it there and give you an opportunity for questions, and I'll stop sharing. Thank you.
Thanks, Kate. Questions have been flying in there, so we'll try and get through them all if we can here. Just on that last side, actually, we'll tackle this first question first. Talking about Canada, the question is, would that be through acquisition, kind of like, when you moved into the UK market, to kind of really give you a beachhead, or will it be, a remote kind of, we're going to sell into this market with a slightly adapted NHS Miya platform, or slightly Australian adapted platform, and just have a BD underground there going around to hospital groups, provincial health services as they operate there in Canada?
Yeah. Actually, interestingly, if you go back to how we really entered the NHS market initially, which was through MKM Health, who Alcidion acquired, we actually started with just one person on the ground. We ultimately, after we had a position, did acquire additional companies that gave us greater market share and greater presence in that market. Each market will be different. I think Canada will be about looking at the opportunities and targeted opportunities. I think we remain open to acquisition, but obviously the share price hasn't been as strong as it had been previously, so it wasn't something that we were actively looking at in the last 12 to 18 months. I think we're now looking sort of at the next strategic horizon in respect of the board strategy. So I think the answer is both options remain open to us in Canada, but I think to start off with, we're likely to look at sort of having a contracted BD person on the ground who can do the analysis work for us, and then maybe consider how you accelerate.
Yeah. Okay. And next question is on, obviously a lot of your clients are government funded. So does this mean when they release tenders, the client usually specifies a price range the bid needs to come in at, and therefore that kind of restricts your like pricing power, or maybe just talk to the ability to kind of get what you want out of it in the constraints of, the tender restrictions coming from, budgets are not overflowing in any market anywhere, I don't think, these days.
Yeah. Look, I mean, our prices have held up. Most tenders don't have a pricing cap. I mean, behind them will be a business case that probably has a pricing envelope that the customer's aware of, but they don't usually expose it to you. The UK electronic patient record tenders is the only place I've ever actually seen them say, we want this to come in within this scope. So there's always room for negotiation around price, and we are not the cheapest bidder, but we have won nearly every tender. Well, we've won every tender we've gone for in Australia in the last 6 to 12 months, and we haven't had to do that through price cutting. So, our prices are holding up because we can demonstrate value. But, of course, the healthcare market is under challenge, like everywhere is, in terms of budgets at the moment, and you have to be mindful of how you're structuring it. So we keep an eye on it.
Next question then. I think this is kind of more talking FY26 and beyond. Well done on hopefully achieving profitability and free cash flow for FY25. Let's assume we hit guidance there. And the market's kind of reflected that step change in where Alcidion is. Going forward, do you see the business having a more balanced growth versus profitability? Because, you've been in a big growth phase kind of since 2018, if we can go back all the way that far. Because they say, I think the market is kind of rewarding you for that more balance now. Okay, so all out growth, build a platform, get up to, a kind of an inflection point. After that, it's kind of like, okay, how much do we want to spend on CapEx versus what do we want to try and keep the kind of profit number, ticking over?
Yeah. I think the market is still wide open for us, but we have really invested in the platform. So my position at the moment is that we will still go after growth, but with profitability. And so we don't see a massive increased investment needed in our platform. We don't see a massive increase needed in headcount, and we don't really want to spend a massive amount of money entering new markets either. We think we can do it in a balanced way that will allow us to, get some operating leverage out of the business, but at the same time, not stifle our ability to win new revenue, because there is still quite a large opportunity out there for us.
Yeah, this is actually a good question considering the period we've just come out here. Does contracts I think they're generally 5 years. If we take, the couple of examples you said, inflation in terms of price increases, year over year, how does that work, especially as coming out of a high inflationary environment, suddenly those price increases are looking like pretty big versus when you signed it, most people are thinking, it's like 2-3% plus maybe a bit of a margin.
Yeah, I mean, all of our contracts have a CPI component to them. And to be fair, when CPI is at 10%, we are having a conversation with the customer about who's going to wear all that. But we've come through it pretty strongly, I think. All of our contracts have CPI, and we have called that in at a minimum of 3%, and in some cases it's been more. But we haven't called 10% on our NHS customers when that was the case, because long term I think it evens out.
Yeah. And then maybe final one for me, just quickly to squeeze in the North Cumbria project or contract, I should say. Will we still see project implementation revenue in FY26, or is that going to be kind of front loaded into kind of this second half or the next 2 quarters of FY25?
Yeah, good question. So North Cumbria is, say, 37 million over 10 years. About 2 million of that is implementation. A little bit in this year, the majority in FY26, but even a little bit in FY27, because it'll take probably 24 months from beginning to end to finish that program. And so there'll be still a little that goes into FY27.
Okay, but the bulk is going to fall into next financial year. Okay.
Yeah.
Okay, perfect. Kate, we're just up on time. Thank you so much. I think we pretty much got through all these questions. If you didn't, please reach out to Kate, but I don't want to hold her up here. I know she's got another meeting, I think, to jump to. So, Kate, thank you very much. And we'll hand over to Shaun here, who's been waiting patiently on the sidelines. Shaun, if you just want to take yourself off mute as well. I can see the cover slide of your deck now.
You can see
Yeah, I
the
can see
blue,
the slide,
the
Shaun,
screen.
and your audio sounds good, so you can take it away whenever you're ready.
Thank you, Mark. Good morning, everybody, or good afternoon, wherever you happen to be. My name's Shaun Ankers. I'm the CEO here at Energy One. I've got a little presentation for you. Some of you are familiar with the company, but I will do a few slides, just give a quick background onto who we are. Let's hope this moves forward. Is it moving? Can you see the slides moving?
Yeah, you're on your disclaimers one now. Yeah, you're on to slide.
Yeah, okay, cool. All right, thank you. So who are we? We are a independent global supplier of energy trading risk management software and services to the bulk wholesale energy industry. Bulk energy means traditionally electricity and gas across multiple deregulated markets. Quite a detailed slide, but it is in the deck that's been lodged on the ASX if you want to have a look. But essentially, the business has been around since, look at that 03. It started out as a retailer, pivot to software in about 08, and that's when I joined. And since then, we've been building up our software suite and additionally adding services and geographies to that over a number of years. We've been profitable now for at least 10 years, and the business grows quite well, and I'll show you some slides about that. Thank you. So just at a glance, a little bit about the company. Now 200 people in 7 offices across 4 countries. We're used by customers in 30 different countries across Europe and Australasia. More than 330 customers. We have more than 2,000 users as well. And we put on 50 new customer installs in the year just gone. The company has 31.3 million shares on issue. It floated with 20 million. And of course, we continue to invest and innovate to the tune of about 9% of revenue in any given year. We do a number of things across a number of aspects of the wholesale market. We deal with both the commodity called energy and its derivatives and contracts, and ancillary things around that, including advisory and reporting and the like. It's quite a broad landscape to discuss the energy market, but this slide attempts to sort of do that, encapsulate that quite in a succinct way. We're talking about long-term trading for customers, so that's establishing themselves and also trading long-term, often hedging. We do advisory and consulting on that and risk management for them, but also establishing their long-term contracts in the marketplace. Also, the energy market is set up for shorter term trading, so D-1, which means the kind of day ahead market. You must nominate or schedule or bid your power into the day ahead. And then, of course, you've got on the day, which is intraday. There's a short-term market as well, both spot and pool trading here, pool trading in this country and spot trading in Europe. And D+1, which is what comes after that, which is often considered to be settlements, compliance, reporting, and the like. And we offer a whole bunch of services and software to help you through that entire journey. Software and services used by a number of blue chip customers across the globe, a lot of whom are household names, but there are a variety of retailers, traders, generators, utilities, financial players, industrial customers, and usually the business is B2B rather than B2C. We have a group of products essentially breaking up into what I alluded to before with the physical markets, what you're doing, logistics and short-term trading of the energy. ETRM, which is generally a term for energy trading risk management, which is the more long-standing part of the industry, which is about contracts management. That might be front, middle, and back office, deal capture and settlements. And there's a bunch of stuff around there, market analytics. Think of it like a Bloomberg terminal, and business process automation to cope with all of the ancillary activities you have around the energy industry, market communications, B2B communications, gathering data, and the like. So that's a very quick recap on the company. I have to answer questions, but I'm sure some of the listeners know who we are by now. So I'll just talk about the results. So our half, the last half, which was the first half of FY25, was the best half in the history of the company on a financial metrics basis. We firmly believe this validates our approach and our strategy that we've had for a while now, and we've been busy executing. We had a reorganization, a restructure in the last 2 years to about 12 months ago. That we feel like we've come through that now, and there's a bit of market volatility, well, a lot of market volatility attached to the price spikes in about 22, 23. We definitely feel like we're into a bit of clear air now and growing the business. We can see forward to the horizon. The results show that our efforts have been fruitful. We've delivered, as I said, net new 53 installs in the last 12 months. Our ARR in January is up 18%. And of course, margins are up, which is something we talked about for the last year or two. Our sort of focus on improving profitability. I think we've demonstrated the revenue growth, but obviously profitability is key for our shareholders, and that's something we've been working on as well. Internally, we've improved our processes. We believe we've better engaged with our staff. We're very happy about that aspect of it. We found better ways of working together as part of the restructure. We've also enhanced our cybersecurity. Obviously, anyone dealing with data is now cybersecurity is a very hot topic, and we're seeking ISO 27001 this year, but we've done a whole bunch of work towards that already. I'm happy to take questions on that. But not forgetting that we can continue to innovate, particularly the hot business at the moment is batteries with AI and automated trading. And again, further validated our one-stop shop approach and our positioning thereof with the market, and receiving good empirical evidence back from the market that's been a worthwhile exercise. So basically now the company in Australasia and Europe, including the UK, very important and integral part of those markets now, a key supplier. So well on our way to sort of capitalising on that opportunity. Just dealing with the specifics of our results for the half. Nice to see some green arrows there, so hopefully self-explanatory. Revenue's up. ARR at January, this measure January up 18%. That reason that's slightly different from the December result was it captures some of the commercial improvements we've made that kicked in on the 1st of January. So we just wanted to make sure that those were captured. Margin expansion, obviously, is something we've focused on, and our EBITDA margin is up. Down at the bottom there, our net debt decreased by 8.1 million. And leverage decreased from 3.8 to just 1.4 times cash EBITDA. So a lot of strengthening of the balance sheet arising from generating more cash. And we do have some debt on the books, but that we expect to clear in the next 12 to 15 months. And that's what our focus will be going forward. Very detailed slide here. Again, you're welcome to look at that on the ASX deck, or you can load it from our website. But again, just capturing some of these SaaS metrics, which are quite important in the industry these days. So ARRs of 53.2 million. We've got the churn dropped slightly, but it sort of bounces around in that 2.5 to 3.5% mark. You can see our average LTV to CAC is 58, steadily improved over the years. A typical contract length, 1 to 3 years to begin with, and then annual evergreen contracts rolling over. There's two gross margin numbers there. One is the gross margin that includes amortization of the software, and one is the cash gross margin, which has had that excluded. So you can see what we're doing in terms of GM. And that GM, of course, is blended because we do have services based in there, and one-off services particularly, which sort of reduce the margin somewhat. The underlying SaaS style margins are much higher than that. Okay. So a quick recap on the strategy and what we're doing. Obviously want a strong, profitable and stable business for growth. And I think we can demonstrate that over a number of years. We must have and grow a comprehensive coverage for physical and contract trading needs. We position ourselves as the one-stop shop. This is because our customers require more than one activity when operating in the marketplace, and they're not just selling the one thing. Is not accessing the vertical integration space as efficiently as possible. We have multiple customer types, power and electricity, and multiple commodities, of course, for both customers large and small, so well diversified. We offer software and services. Energy is a 24/7 market, so you might take the software license, but if you're not able to operate in a 24/7 live environment, if you don't have the desk, we can do that for you. We can keep you current in the market and do the operational services part for you. Make sure that you're compliant with the marketplace. We intend to build global capability to service the increasingly global landscape for energy and be a partner for multinationals wherever they may set up assets, especially in new territories, places that are non-traditional markets. Again, investing and continuing to invest in these kinds of new technologies. We want to always service our customers because it's a very important industry, and our customers are fulfilling a very important and vital social task, which is providing power and gas to the marketplace. So it's important we look after them and make sure they're always up. There's a very substantial market opportunity, and I do have a slide on that. Just very quickly, a slide about efficiency here. This is our resources per FTE, and we have steadily increased that over the years. So in the last year or so, revenue per employee has gone up 11%, which is just indicative of efficiencies gained from better working practices. So a quick look forward on what's happening. This is an Aussie slide generated by AEMO, who are the market operator. As you can see, their projections are for significant growth in renewables going forward. This is largely because of the electrification of the economy. We need a larger grid to deal with all of the new electrical loads, such as EVs, which weren't there before. And coal generation is obviously on the way out, as we all know. So it must be replaced with something, and eventually that means renewables plus storage and firming generation, such as gas. And this will play out over a number of years. But as we can see, there's a significant tailwind there. Energy One supports those new generation assets with our technology and our services, and including the existing markets for coal and gas fired generation, and retailers and utilities and users as well. So we're here to support the market as it evolves and grows into the future. And a similar story here in Europe. Slightly different slide, but you can see that they're aiming for nearly half of their generation to be via renewables. In the years ahead, they installed 70 gigawatts of renewables in 2023, which is an enormous number. That's larger than the entire Australian generation fleet just in renewables. So they're forecasting growth of 18% and rooftop solar, non-rooftop solar by 9%. So again, a big strong tailwind towards renewables. Of course, not forgetting that gas is still pivotal and will be for a foreseeable, and we continue to support our customers, and that's gas is a very important fuel source and will be for a long time yet. Europe's got multiple markets, obviously countries spread across Europe, and I do have a slide showing you some of that. So in Europe, of course, they do have an intraday short-term spot market, exchange-based market. It's growing dramatically as people are piling in to do short-term trading. You can see this slide. EPEX Spot is just one of the a dozen or so exchanges across Europe. 11.5 million trades a day at the moment. Obviously, a significant number of trades, and that volume is exploding across Europe. This slide briefly covers our coverage, which we consider to be best in class or close to it in Europe. There wouldn't be many players, maybe one or two even come close. So we're busily expanding. The market in Europe is expanding sideways, as well as the prior slide, which showed you getting deeper. And of course, you know, as more renewables or more players enter the market via the new growth in renewables, we'll have more individual players looking to trade and hedge and close their positions, which is what these markets are all about. And this one just shows our progress thus far. The green area represents 75% of the volume in the European market at the moment, but then the orange parts represent the next steps, and we're working on those. So, brief summary of my presentation. Highlights going forward. We feel the advantages of our global and capable business that we've been slightly rejigging recently are starting to bear fruit. There's numerous examples of shared resources across our teams. We've structured with a more conventional software company format with functional heads and country leadership. Marketing activity continues. We've been quite good at marketing and continuing strongly. Website hits up 42%. Some 180 leads generated from in the half from the website alone. Global CRM now. We didn't used to have a global CRM in the last year or so. We've installed that amongst many other standard systems that we've now put in, showing our pipeline values increased 16% in the last 12 months. And of course, continue to work on that. Cybersecurity investments continuing, although they are somewhat stabilizing. We have now in place a 24/7 SOC, as they call it, which is a security operations center, and we're going to be getting 27,001 in this year. Our one-stop approach is a differentiator against more pure play competitors. It's traditional in this industry for vendors to focus on one product, one type, or one area and get really good at that. We, for a long time, have differentiated by saying that we're a one-stop shop, a platform for all of your needs. And this evidence is resonating with our customer base because in a recent, very large trade show in Europe called eWorld, 7 out of 10 potential customers tick more than one box, indicating they were interested in more than one aspect or more than one product. So an example of this, just a sort of anecdote. We've got one customer who we provide the contract software out of the UK. We do the power ops out of France, gas ops out of Belgium, and of course the night shift out of our Adelaide trading desk. We believe we're the only vendor in the world that actually can do this. But it's indicative of a truly global solution. We do remain open to good acquisition opportunities as they arise, and we continue to explore those, as well as any other joint venture or other partnership, tactical, whatever that is going to be useful to help us develop the business. Again, continue to focus on margin expansion to accompany our efforts in growing our revenue. Thanks, Mark. 2 minutes early. Not bad.
All of those 2 minutes because questions have been flying in here. So I'm going to apologize before we start if I don't get to your question. Let's kick off with the first one. Growth from this point onward, Shaun. I know you touched on it just as you finished up there on that last slide in terms of being open to acquisitions or stuff, but is it more about selling to the 300 plus clients, or is there still large white spaces to win in terms of like new logos? So maybe, yeah, I guess in like existing markets that you operate in.
So that's the new logo slide, if you like. The new entrants into these markets are generally independent. About 85% of the new developments are independent power producers, or as opposed to the existing utilities. That number might jump around, but you can see that what we're doing by that is generating more potential customers. It's a fragmentation of the market. That fourth bullet point there, number of generators in Australia is up from now 250 odd, up from 150. So the number of players is growing in the market. As to our what we call cross-selling and the like, if I refer you to our NRR slide there, so NRR stat. So on balance, we're getting about 104% of net revenue retention across the existing customers, which in the enterprise business, which is where the larger customers, generally speaking, very stable at 107 odd-ish. Our SaaS business, bits more smaller customers, it sort of jumps around a little bit, but overall, we're generating about 4% of new revenue out of existing customer base. So very important to us to continue to grow those customers and grow with them as they grow, which might be more seats or more geographies or more commodities that they want to trade in. So both things, existing customers and of course trying to pick up the new logos.
Yeah, I think you did mention it, but just for the sake of clarification, the remaining debt that's on the balance sheet, I think you said 12 to 15 months to pay that down, and then, yeah, is that just going to come, cash flow as kind of monthly, quarterly payments come up, and it just kind of naturally runs off the balance sheet?
Yeah, so we obviously are generating free cash flow now. We have been for a while, but at a level where we can sort of pay down that debt, and that's sort of the focus. Of course, that debt traditionally is what we have used for acquisition over the years, but we've been very diligent over the years in paying it down within perhaps 3 years of taking each event. We've paid it off in about 3 years. So obviously that discipline is important to us.
Yeah, here's another, I think, a good one as well. What's the company's view on buy versus build when it comes to software product development?
It's obviously the perennial question. Obviously, as you get a little bit bigger, becomes agility to move quickly is traded off against your ability to acquire some technology from others. So each case is measured on its merits. We obviously, generally, everyone would prefer to build because you control control all of it, and it's used your existing tools and so on. So it's an extension of your capability. But when you go to buy, if you can move quicker into a rapidly opening space and pick up customers at the same time, then that is something that you should consider, and it's something we would weigh up each time that we do it. But I don't think there's any right or wrong answer to that. It really is just a judgment based on the situation that do I need to move quickly here? Does it make financial sense, or is it better to build it myself?
You mentioned the 50 new clients that have come on board. Is that already reflected in first half 25 revenue growth, or are they yet to go live? And a bit like, I guess, our previous presenter, Kate, you also have a section of product implementation revenue and then, the SaaS contract revenue coming on after that. So maybe just give us a split or a bit more context to that.
Yeah, so generally, by the time they get to be called installs by us, they're already in. There might be a couple of, in process, but numerically, the majority of our new installs are in the SaaS type of business, so they go in quite quickly. We would have a handful of enterprises. So we don't have, I would say that the majority of that income is already in the ARR, although there may, not sort to say some portion of it might still be forthcoming.
Okay. Another question then on EBITDA margins in terms of, do they change across geographies? So Australia versus Europe, and electricity versus gas. And, in 5 to 10 years' time, where do you see margins? Is there better margins in, these smaller players and, the renewable space and batteries and all of that coming down the line? Is that going to be a more margin-rich environment for you, given there's so many more players and so much more balancing that has to be done? Because instead of dealing with, a couple of large legacy generators, now you have a whole plethora of whether it's traditional gas, electricity, wind, solar, batteries thrown into the mix. It's a more complicated environment than what we were where we were in energy space 25 years ago.
Sure. And I think you've helped me answer the question there, so I appreciate that.
I'm just loosely thinking complexity equals more margin.
Well, it certainly does. And this is we've actively diversified the revenue base. The slide shows that. You can look in detail in one of the segmentation notes. You'll see that the Aussie business does generate more margin than the European business. One of them is more mature than the other, and you can actually see there's a bit of a story to be told there. But yes, certain products are more produce more margin inherently, perhaps. But that's also a stage of proceedings. As SaaS grows, you get more customers, then that margin increases. So they're all operating on their own slightly different journey. But we've done diversification for many years as a policy, and the good thing about that is that you've got this portfolio of products at different stages or solutions at different stages, and you're looking to improve the ones that are up and comers and make the most of the ones that are sort of more mature. So we do work on it at all times. As I said, the broader statement is that Australia is more established for us, therefore the margins are higher. But yeah, that complexity helps a vendor, because every time the market changes, that's an opportunity. The last thing a vendor wants really is a very stable marketplace.
I'm gonna take this one here because I know it's something you have addressed in the past. Plans to increase liquidity in the shares. I know historically, you did a lot of underwritten DRPs back in the day. I don't think that's been running for the last little while, but yeah, maybe just talk to that kind of general liquidity, because a lot of the founders and the board have been in there for quite a long time, and are not really active sellers of EOL.
No, and I think the focus of the business over many years has been discipline and that capital management side. So we floated with 20 million shares, and 18 years later, we got 31 million shares. And so that's actually a feature, not a bug. So we like it that way, and the shareholders hopefully appreciate that. So of course, we all recognize that that's caused some frustration. The DRP was attempting to introduce a little bit more liquidity in a slower way. We do occasionally have occasional cap raises, which we've kept as modest as possible. And where possible and where it makes sense, we do try and allow as much participation as possible, and also look after the existing shareholders. So we'll just continue to be as disciplined as possible, and with understanding the desire of the market to get more shares. But obviously, we just continue to do what we're doing, and with time, it'll solve itself.
Yeah. This is actually a good one and a bit more EOL 101, but where the question is, where does EOL fit in slash compete with the likes of Gentrack, Hansen Technologies, Quirke, and where are those guys in relation to you? Are they competitors? Are they just servicing other parts of the market, but they're in your space more broadly?
Well, they're all very fine companies, but we don't compete with them. They are what I'd call in the retail, more the retail customer, end customer part of the industry. We're in the wholesale, if you like, midstream. If you want to use that oil and gas expression, we're midstream and upstream, not downstream. So we don't compete with them. So good luck to them, but we're in a slightly different space.
Mid 24, you already have Europe operational night shift covered from Australia. And then the question is, has the reverse happened? Are you covering, have you started covering Australia from Paris?
Indeed, we have. So we have effectively now got the follow the sun in operation. Predominantly, there's some things that some assets and whatnot that we still do both sides. So we have cover each way, but we've been experimenting increasingly with that cover to the point where now we have a functioning follow the sun operation.
Okay. And I'm going to put this one in as a last one because I think it might be a quick answer. Uh, Adaptation for various markets in terms of, the core system, like how much tinkering do you have to kind of do, just to get it ready for, the generators that are in a particular market, regulatory environment in a particular market, like how customizable does it have to be, or is it kind of, energy trading is energy trading, give or take?
So with enterprise customers, the larger customers, they usually want some changes. So that software that is picked up by enterprise customers that relates to all one-off revenues that you see in there. That's kind of the exception rather than the rule. For our sort of off-the-shelf SaaS style software, the only changes really are these kinds of wiring changes for new markets. The software itself is everyone uses the same code base. So it's one product for everyone, and if we wire into a new market, then everyone gets the benefit of that. Of course, we do ask for a small increase in the fees to help you out.
Yeah. Okay. Shaun, we're bang on time, and our next presenters are after joining us. So apologies. I can see we've got 20 questions here. Unfortunately, we didn't manage to get to them all. But please, yeah, do reach out to Shaun if you have got further questions. I know the contact details are on the slide deck there, and we'll get him back in hopefully later in 2025 if his extensive travel schedule allows us to find a gap, which has proved difficult at stages. But Shaun, thank you very much, and yeah,
Thanks,
hopefully
Mark.
we'll speak to you later in the year.
Thank you, everybody. Goodbye. Thank you.
And with that, I'd like to hand over to our third presenters of the morning. We've got Lucas Murtagh and Damian Smith here from Asset Vision. Gentlemen, good morning.
Good morning, Mark. How are you?
Very well, Lucas. And Lucas, just I can see the cover slide of your deck now. I believe you're driving the slides for Team Asset Vision here, so you can take it away whenever you're ready.
Awesome, Mark. I'm glad I got that part right. Rightio, let's kick off. So again, look, Mark, thanks for having us today. Hello to everyone tuning in. My name's Lucas Murtagh. I'm co-CEO of Asset Vision, and I'm joined by Damian Smith this morning, co-founder and co-CEO of Asset Vision. G'day, Damian.
Hey, Lucas. G'day, Mark. Everybody else listening, hello.
So look, we're really excited to share our half-year results today. The board and the management team are incredibly proud of what we've been able to achieve and the progress we've made over the last 18 months. And just for everyone listening, this presentation is available both on our website and via our ASX announcements page. So look, just to cover off the corporate side of the business, Asset Vision trades under the ticker code ASV. We've got 739 million shares on offer, and as of this morning, our market cap is sitting at $33 million. We ended the half with just under $1 million in the bank, which was a great result. For some of you that know that we haven't raised money for quite some time now, and we've got money in the bank and we're cash flow positive, which is really important for us. For those of you that don't know, the corporate shell has quite a history with a few name changes over the past 5 years. Originally, it was PS&C, which was a professional services company. Then came Future First Technologies, which was a roll-up of several digital businesses, and one of which was Asset Vision. So back in FY23, the board made a decision to focus Future First Technologies entirely on Asset Vision, and it was at that point that Damian and I became co-CEOs. So at that time, with the board, we set out a clear strategy, and that was build a great SaaS platform, get the annual recurring revenue growing, and return the business to profitability. And one of the other key outcomes of that was to extinguish our debt. We looked to attract a market-specific board, and the last thing in our priorities was to change the name to Asset Vision. So it was clear who we were, what we did, and the markets we serve. So 2 years on, we're happy to say we've delivered on these priorities, which has been a fantastic result for the company. In terms of substantial shareholders, you see a couple of instos on there. So Salter Brothers are on our register, as well as MA Financial. DMX Capital have recently come onto the register, which is great to have them on board. And the top 20 shareholders account for around 60%, 68% of our total register. So it's a pretty tightly held stock. And as you can see from our share price chart, we've experienced some solid growth over the last 12 months, which is great for shareholders. As mentioned, one of the key priorities was to build a board aligned to our market that we operate in. And over the past 18 months, we've been pretty fortunate to bring on two very experienced directors. Our chairperson is Luke Donnellan. And for anyone who's met Luke, you'll know what a passionate person Luke is. He was a member of Parliament from 2002 to 2022. And what really attracted Luke to Asset Vision was the work he did during his time as Minister for Roads and Minister for Ports. So he brings a deep knowledge of infrastructure and government policy and process, as well as a strong network across government. Our second independent director is Peter Board, and we're really happy to have him on board. He's the former Chief Commercial Officer at Ventia. He brings exceptional expertise across commercial strategy, business development, risk and law, along with a deep understanding of all of our asset verticals. And this comes from his experience leading major divisions at Ventia and Downer, including transport, rail and infrastructure. Damian, I might throw to you to introduce yourself.
Yeah, sure. Thanks. As Luke has mentioned earlier, I'm the co-founder and co-CEO of Asset Vision. My background sort of started in the early 2000s, where I founded a software business and found myself developing asset and maintenance management systems for several clients for about 10 years in the end, and eventually decided to take all those learnings and build a product of my own from scratch, as well as transition to a SaaS business model. And this was essentially the beginning of Asset Vision. Today, as co-CEO alongside Lucas, my responsibility is to lead both our product and delivery teams.
Great. Thanks, Damian. Just to introduce my role. So my role at Asset Vision is all about growth. So I lead our strategy from both a go-to-market perspective and a corporate growth perspective, which includes investor relations. For a bit of background, my early career was predominantly finance and actuarial, but since then it's been mostly entrepreneurial pursuits. I've been lucky enough to see multiple startups through to exits. And lastly, but not leastly, is our CFO and company secretary, Vesna Jalesic. Vesna's been with the company or the corporate entity through its entire journey, from PS&C through Future First Technologies and now Asset Vision. So she brings a strong financial management and corporate governance background to the team. Damian, I might hand to you to give a bit of an overview of our business.
Sure. Look, as I mentioned earlier, I ran a software business from the early 2000s, and this was a really early time, sort of when smartphones hadn't been invented yet. GPS was slowly on the rise, and mobile data wasn't even around. There was an opportunity for me to create a maintenance management system for a road contractor, and doing that enabled me to see firsthand their processes and challenges that were involved to inspect roads and capture defects. And back then, these were all manual-based, sort of paper-based systems and voice recording systems. We found a PDA that could be used out in the field, and I sort of set out to build a mobile data capture tool, and spent quite a bit of my time on the road with the guys and working with their teams in the depot to try and get a solid understanding of what everyone needed in order to sort of do their jobs effectively. And that experience I went through ultimately shaped the foundation of Asset Vision in years to come. And so when we built Asset Vision, we knew that while roads and transport related assets were a core strength for us in terms of where we'd been, our knowledge and experience, and even we'd shape the product around those types of features. But we still wanted the platform that we were building to work across any asset classes, even though we actually didn't know too much about them at that stage. Eventually, this opened the doors to local government, where roads is just another linear asset in their portfolio. But they also have things like buildings and parks, open spaces, footpaths, bike tracks, drainage, many others. And Asset Vision fit in really well there. And more recently, we've found AV is a great fit for ports. We've just gone live with Gippsland Ports here in Victoria, as well as utilities, where we're going live with Rouse County very soon. Essentially, they're a regional water supply authority. So that's in just a couple of weeks, actually.
Great, thanks, Damian, and fingers crossed for the guys up in the Northern Rivers that Alfred is not too disastrous for them.
Absolutely.
Fingers crossed. So, look, from a customer point of view, as you can see on this slide, our broad client base is one of our greatest strengths. It's essentially an ecosystem of users all working together in a single connected environment. And as this user base grows, it fuels a network effect that continually opens up new revenue opportunities for us. Just to give you a quick summary of our existing customers, on the asset owner side, we work with government bodies like Transport for New South Wales, Victoria's Department of Transport, and the Government of South Australia, as well as a growing number of local councils across the country. These clients use Asset Vision to centralise their asset registers, track inspections, manage maintenance and capital works, and monitor performance. And that's whether it's their own teams delivering the work or their contracted service providers. On the service provider side, we work with some of the biggest names in the industry, including Ventia, Fulton Hogan, Downer, Athiona, Johns Lyng Group, and Stornoway. These providers use Asset Vision to drive operational efficiencies, exceed their KPI targets, capture and manage defects, and maintain asset register data on behalf of the owners they work for. And beyond the major players, we also support over 100 subcontractors, and that number's forever increasing for us as part of their larger contract delivery teams. Damian, I'll hand back to you for a deeper look at the platform.
Yeah, thanks. So it's probably a really good time to explain what Asset Vision actually is. And that is an enterprise asset management system, or an EAM system, that we believe asset teams love to use. An EAM system is responsible for many, many things, but primarily it's a tool to help organizations track and manage their physical assets over their entire life cycle. Essentially, it's like a central hub for everything related to an asset, where it's located, its condition, what maintenance has been done on it, what work's planned. And EAM systems, they also help coordinate work teams out in the field with scheduled inspections, maintenance activities. They help to measure compliance with service level agreements, provide insights into past and future costs for effective budgeting and planning. Asset Vision, of course, does all these things. We connect asset owners, service providers, and maintainers together on the one platform, similar to what Lucas was just describing. Traditionally, they'll all use their own systems and they struggle to share data. So we believe having them on the one platform is the best possible outcome. Our mobile app has been built from the ground up to empower field workers with the technology that's simple and that they can use and understand. We can configure AV to suit the most complex business processes and still keep everything really easy to use. The system is been designed to transform around the client's needs, not the other way around. We're always pushing the boundaries of technology, improving the safety of road inspectors and efficiency of road inspections using AI to pick up road and roadside defects, and I'll talk about that a little bit in a minute. And finally, look, thanks to our technology and of course, our amazing team, we implement AV in weeks, not years.
Thanks, Damian. So look, talking about first half performance from a financial point of view, I just want to jump into actually how Asset Vision makes money. So we have two key revenue streams. The first being licensing revenue. So this is our recurring revenue from customers subscribing to use the Asset Vision platform. And that's generally on a per user per month basis. The second line item is services revenue, which comes from project implementation work, onboarding clients and integration. So looking at our financial performance for the first half of the year, we're very pleased with the result. And our strategy is clearly delivering strong revenue growth and profitability. So total revenue for the half was just over 2.9 million, which was 20% up on the prior year. This was driven by a 26% increase in licensing revenue as our annual recurring revenue continues to grow, and a 47% increase in services revenue. The more clients we bring on, the more that service revenue grows. A key other line item there is our R&D grant line item of just under 500K. Look, we expect this number to continue at this level for the foreseeable future. The history of the corporate shell, we do have some accumulated tax losses, which will enable us to continue to receive this R&D grant. From a cost point of view, we're down 3%, which is a fantastic result alongside our revenue growth. And as we continue to scale revenue, we expect our margins to expand further because we've got a cost base that's very stable now. It's also worth calling out that our corporate costs remain very low compared to our listed peers, which also gives an advantage as we grow. Well, I suppose the key highlight for the half is our EBITDA of 717,000, which was up 430% on the prior year. Now we're profitable, we're cash flow positive, and we're in a great position to continue our growth story. Look, if we look back and understand what's driven our success over the past couple of years, it really comes back to having a clear set of priorities and staying focused on them and delivering against them. So these 7 priorities that we've got on this slide guide everything we do, from how we invest in the product and support our customers through to how we grow the business and look after our people. And I think the results we've shared today from our revenue growth, profitability, and strength of our customer base really demonstrate that this focused approach is working. And with that, Damian, I might hand over to you to talk about priority 1.
Sure. Thanks. Yeah, so look, our product development roadmap, it's an ongoing cornerstone activity in our company. Look, no matter how good a platform is, there's always improvements to be made, and it never stops. So it does become quite a task to undertake everything that we want to do, as well as keep up with the day-to-day needs of our clients. And we move pretty fast with our releases. We average about 1 new release per week presently, and these releases can have things like minor fixes and improvements, but also nice big new features as well. And we're quite accommodating when it comes to taking on feedback from clients and requests for product changes and enhancements. And these items all, they kind of work their way into being prioritized for our development roadmap appropriately. And over time, I found practically everything we do can be categorized into one of these groups that you can see on the screen. And it works really well for us to maintain continual forward momentum across these groups and really balancing where we spend our time. So the core platform is the general day-to-day operational use of AV across web and mobile. Our platform's really mature. It's been around for a long time and it's quite feature rich. So sometimes these are smaller in scope, but larger in number as we work to make things easier for our users. And of course, there's always big new features that pop in as well. Integration is really, we need to keep improving and adding to our APIs so that our clients can build system to system interaction with AV. Often AV's part of a bigger suite of systems in play. So being able to exchange data between systems with modern APIs becomes pretty crucial. And I also extend this category to, I guess, administration. We want our clients to have the tools that they need to manage every aspect of AV themselves. So we've got to keep building out these tools as our features continue to grow. On the tech stack, this is really about making sure we're using our technology frameworks to their fullest potential and optimizing the performance of the system continually, as well as keeping our tech debt to a minimum. So every software system out there has its share of tech debt, and it's definitely an ongoing risk that needs to be managed. And we need to, ensure we're moving our underlying programming frameworks and infrastructure forward. So we're not waking up one morning and realizing a critical component of our tech stack is now unsupported or obsolete. So the work we do here is largely invisible to our clients, but it does, nevertheless occupy a lot of our time behind the scenes. For innovation, that's pretty obvious. This is the fun stuff. This is the experimental R&D category where we can, test out our craziest ideas. And I'll probably get into highlighting some of those now, actually. Autopilot. Autopilot's a key innovation that we released in 2023. So just for some quick background, it enables continuous capture of images during a driven road inspection. And so to ensure that the roads are safe for us all to drive on, they need to be regularly inspected for defects. And the way that this has been done traditionally is very manual and requires the inspector, who is also usually driving, to concentrate on both driving and identifying defects, which is not ideal. And so with Autopilot, we provided the inspector with an iPhone mounted on the inside of their vehicle on the windscreen with its camera facing the oncoming road. And as they drive their usual route, AV is automatically capturing images every 10 meters or so and sending these up to the cloud. Then later on, either that inspector or somebody else in the depot or the office is able to perform a playback of the inspection and look for defects. So what this shift means is that inspections are now much, much safer because the inspector can concentrate on driving, and the quality of the inspections undertaken is improved because the person reviewing the playback can fully concentrate on that task as well. But this slide's about Autopilot plus AI, which we released for the first time in mid-2024. And this is all about having automatic recognition of defects from those images that are captured through the Autopilot process that I was just talking about. And so when we released Autopilot AI last year, we focused on cracking and pothole recognition, as these were the most requested pavement defect types from our clients. We sort of asked a whole bunch of them, and that's what the consensus was. But you can see here down below there, our plan is to expand into other defect detections this year. And we also released late last year, we actually added detection for guidepost defects, and that's where these are leaning greater than a certain tolerance. And a month ago, we actually introduced new functionality which allows us to get approximate measurements of the detected defects through LiDAR-based techniques, which you can see those little measurements there on that image. And Autopilot Rewind, a week ago, I think it was a week or just over a week, we released Autopilot Rewind, and this is something that it definitely started in the innovation experimental part of the roadmap. It was just a concept to see if we could do it, and we've been chipping away at it for about 6 months on and off. And really, the goal here was to make it as simple as possible for users that are playing back those inspection images to easily see what that same area looked like the previous time a photo was captured there, and the time before that, and the time before that, and so on. And you can imagine as more kilometers are driven each day, we're banking, tens of millions of photos. So to have an easy way to access and compare photos at different points in time, but at the same location, became an interesting challenge, especially as photos aren't necessarily captured at precisely the same location each time. They might be in a different vehicle, maybe a little bit higher or lower, or slightly different angles, and they might be forward or back a little bit from the previous shot. So to make the playback feel, like the rewind playback feel, as natural, as seamless as possible, we didn't really want the images to be kind of jumping around. We wanted to make them as static as possible, and so we applied various techniques to have the previous photo kind of crop and alter and skew automatically to match with the primary photo. And the effect is really cool, and we're actually pretty happy with how it's turned out so far. But the main point behind all this, of course, is to provide asset managers with ease of access to those historic images, as they're the ones who can visually assess and identify trends and ultimately decide where to best spend those limited funds.
Awesome, Damian. It's really cool technology, and our clients are absolutely loving it, who are starting to test it out. I just want to run through some of the success stories for new revenue growth. All of these customers have come on since January 1, so we're really excited that Mineral Resources has entrusted Asset Vision as the platform they will use to manage maintenance on the Onslow Haul Road. And it's a pretty significant piece of infrastructure in Western Australia. And no doubt a number of you would have seen some stories on it in the paper. Also coming on board since 1 January has been Athiona with the Toowoomba bypass. Again, they've entrusted the Asset Vision, the platform, to manage their maintenance for this pretty important piece of road. Damian, just want to quickly say about how existing clients are starting to take on Autopilot.
Yeah, look, that's pretty much it. I mean, clients are, you said it before, clients are really responding to Autopilot, the benefits of Autopilot, especially now with the AI and the rewind. And we're seeing a really noticeable increase in that interest and uptake, which is amazing. And because Autopilot is so easy to get up and running, where we're offering no-cost trials to councils, where we loan them a kit and we set them up in their vehicle, and the response has been really positive.
Great, thank you. And also Capital Works, Damian, just some of our clients utilising this new feature in their day-to-day operations.
Yeah, look, Capital Works has been a part of Asset Vision in terms of its core functionality for a while, but we've done some pretty significant enhancements there over the last little while to make it, I guess, more accessible and usable, and that's led to new and existing clients, I should say, bringing on new teams, resulting in increased users and user numbers.
Great. Hey, Mark, I'm just conscious of time. I might flick to the final couple of slides of the prezzo. So, as discussed, we've had a pretty good start to the year, with recent client wins adding around $400,000 of annual licensing revenue to the top line, and we've got multiple deals at proposal stage. So we're expecting a lot more growth over towards the end of this half, which is pretty exciting. The growth strategy you see there hasn't changed for the past 18 months. We're going to expand through existing customers through new contracts and products, while targeting new customers across roads and adjacent assets. For example, local government facilities, ports and utilities. And we're confident this approach will keep the revenue growing. So just to quickly sum up, we're a proven platform. The platform's built, customers love it. We're operating in a large and growing market. Infrastructure is everything in this world we live in. Our financials are good, and we've got an experienced team driving it forward. So we're really excited about the opportunities ahead. So yeah, thanks for your time, and we'd love to open it up to any questions.
Thanks, gentlemen. Just a quick one. I don't know, maybe it might be more for Damian. R&D, Damian, does that get expensed through the P&L every year, or is some of it capitalized, or maybe just because I know that's a question that perennially comes up when we're talking about software businesses?
Yeah, I might throw to Lucas to answer that
Yeah,
one.
no, it's all expensed,
Okay.
Mark.
I know, I thought it might be when Damian said how quickly you roll out features. I was thinking, yeah, it's probably going to, but just to clarify.
Yeah, look, we're constantly innovating. Like we're definitely we're not stopping with any of that. So for sure.
And then in terms of Lucas, revenues and margins, and the length of time for contracts, does that change as you move across kind of the three main customer groups? Is it different, for state, local governments versus the service providers versus the contractors, or are they all kind of basically on the one template? It's just the volume of users that are coming on with a particular customer segment.
Look, it's pretty consistent across all our verticals as how we're growing. I think a question we get all the time is lead time around our different verticals on how long it takes to close a deal. We work, with government clients. There's the positive and negative side of that. The positive side is once you win a government client, you're with them for a very long time. On the negative side, it does take a long time to win government work. So we're balancing that with winning service providers who generally the sales lead cycle is much shorter.
Okay. And then another one, who does Asset Vision compete with? Are you competing with other players in this space, or is it more competing with the incumbent system that they have? They've got an asset register that's sitting on an ERP system, but all the other stuff that Asset Vision can bring, as well as, okay, here's the just maintenance record plus the asset. Is it that what you're more competing against?
Look, there's various levels. So at the highest level, we compete against the big players, the big global players. So your SAPs, your IBM Maximos, and your Infor. So that's at the big enterprise side of town. From that mid-level, we're competing against Siemens Brightly's products, Technology One in a local government space, and then various other systems. We're still competing against Microsoft Excel in some clients, Mark. There's still a little bit of maturity left to go in the infrastructure space.
Yeah. Okay. Gentlemen, we're just slightly over time, and I do see Peter has joined us, who's our next presenter. So we'll leave it there, and hopefully we can get you guys in later in FY25.
Wonderful. Thanks, Mark. Thanks, everyone.
Thanks, Lucas. Thanks, Damian.
Cheers. See ya.
With that, I'd like to welcome back Mr. Peter McGrath joining us. I don't know, must be fourth, fifth time, Peter. You're welcome.
Yes, thank you very much.
Peter, if you want to start sharing your presentation deck, I'll let you know once it's coming through. Yeah, it's just loading now. Yeah, I can see the cover slide now, Peter. You can start whenever you're ready.
Great, thank you. And thanks everyone for joining us this morning. I'm going to run through an update on our recent half-year results and also give you some key highlights and also what we're seeing in the market. For those who haven't joined us before at one of these sessions, a bit about Comms Group. We're a specialised cloud communications and managed IT service provider. So we provide the latest generation cloud communications and managed IT services to business. You can see some stats there on when we were listed on the ASX. We have operations in Australia as well as in certain international locations. We do have a key focus on cash generation and generating strong shareholder returns. And we have 3 key divisions within the business with a mission to enhance business agility for our customers. And this is through innovative cloud-based communications and secure modern workplace solutions. So there's our 3 divisions there within the business: our cloud communications and collaboration business. That's a domestic business where we provide services to Australian SMEs and corporates. We've got a very strong name in the marketplace, servicing corporates and providing the latest generation cloud-based communications services and collaboration services. Our secure modern workplace solutions, once again, an award-winning business selling, some of the latest generation workplace solutions services, such as the full Microsoft suite under a very structured and productized arrangement. And that's a very high annuity and recurring revenue business. And then our global unified communications and wholesale business, where we provide services to businesses either directly or indirectly who require the latest unified communication solutions for their businesses in multiple locations. There is further information at the back of the pack on our products and services that we do provide. So in terms of our key highlights, our revenue was 27 million for the half, which is slightly ahead. Our global division revenue increased in the period. I'll come to that shortly. Our underlying EBITDA of 2.4 million. We did make an active decision to invest in some additional resources, particularly within our global business, which has cost us a little bit. We have made that decision to invest ahead of time to provide some additional resources. And we're seeing not only did we get some great sales within the half in terms of new business, but that's continued into the new year. And we've got a really strong pipeline of opportunities there. So we see that as a key growth option for our business, and hence the investment in additional staff. In terms of new business signed in the half, we measure that by either the monthly recurring revenue that adds or the annual recurring revenue, which is obviously 12 times that figure. So we signed a total of 5.9 million in new annual recurring revenue in the half. That's our highest level on record. That came from across the board in terms of our 3 divisions, but particularly in our global business, where we had some great wins. And that new business will start to flow in this particular half. Our gross margin improved to 48.3%, and it's one of the key focus areas for the business. We want strong, profitable growth. So we're continuing, to focus on managing our supplier costs. And so we saw both a margin increase and a gross profit increase. We had a continued strong cash flow position. We did have a delayed debtor of circa 600,000, but we've entered into an agreement with them where that will be paid in this half. But when you make the adjustment for that, it was a very strong cash flow position. And separately, we had a number of key highlights within the business, such as completed key security certifications, ISO 27001. We already have SOC 2, and also we're going for UK Cyber Essentials as a key way to unlock further opportunities. We did announce an interim dividend of 0.125 cents a share, fully franked. So we are paying some taxes. And that's really as a result of the fact that, obviously our tax accounts are different from our normal accounts. Some items are not tax deductible, as we would see, say depreciation, amortization in our normal accounts. So we are a tax-paying business. And as a result, we're able to deliver a fully franked dividend. Just moving forward, our global business, I have touched on this in the past, and I think the attendees today can read more detail on our global business, but in summary, two key areas. We provide unified communications as a service solution for typically corporates, example, Microsoft Teams calling or Cisco WebEx calling, but we also provide wholesale voice solutions for large carriers. And our focus is in the Asia Pacific area. We have made some further investments in that business to expand our license footprint in Asia Pacific. Today, I believe that we would be the most licensed carrier across the Asia Pacific. Now, just for the investors looking at this, that is not an expensive regime for us. We're typically able to obtain these licenses, which take some cost up front. The ongoing costs are not particularly expensive, but importantly, with those licenses, we then have the ability to be able to provide these local voice services that we provide, and we can deal with the local carriers. A couple of key deals that we did announce in the half just gone. We did announce a significant contract worth a minimum of 2.4 million over 3 years. And that was with a global software as a service provider. And also another key deal was announced in November to provide key telecom service to a global technology company. So there were some great deals that we announced. We've seen some further great deals coming through into this second half. Just a bit on the global network. We've just provided a little bit of a different outlook on our global network map there. You can see our points of presence around the world. We run these in very modern data centers using cloud services. These actual points of presence then connect into the various carriers, and then also the key UCaaS providers such as Microsoft, such as Cisco. Worth noting a couple of factors here. We deliver a product called SIP, which is really the standard for IP telephony, and we can deliver that in many markets around the world, and we're finding that this product is particularly in demand currently, and we're winning some great deals, particularly via some of our key strategic partners, some large carriers. We can deliver these SIP services in many countries around the world, and we're often used to extend their core network. So that's been a great product for us. We got some really good momentum with that currently. These points of presence that you see around the world, we have a number of key nodes, particularly in the US and in Europe. And then we found in Asia Pacific that we need to put these nodes in many of the key countries we operate as well. We've also gone on to the Operator Connect platform. And so those corporates who are familiar with that, that's a Microsoft platform, and we would have the most extensive coverage on that platform today of an Australian business. And unlike most of the other providers of Microsoft Teams calling or Cisco WebEx in Australia, including some of the largest carriers, they typically only provide services domestically. We provide services particularly into the Asia Pacific region as well. In terms of financial highlights now, we'll just have a quick look at that. Our revenue was up 0.3% to 27 million, our gross profit to 13.1 million. So that was a really positive sign, and we saw further increases in gross margin. Our underlying EBITDA was down, and that was as a result of those active decisions we made to invest more in some of these key global resources in the half. Operating cash flow was down as well, but really as a result of that debtor delay of 0.6 million. In terms of our financial performance, you can see there our P&L, with our group margin moving to over 48%. The increase in operating expenses is shown there, which was mainly resources to support our global business. In terms of operating revenue, 27 million for the half, and you can see the breakdown amongst the various business units there. And you'll see that our secure modern workplace solutions was around about on par with our previous corresponding period of 9.3 million. We had an increase in the last half, which was the period immediately before that, due to some key project work that we undertook. But the 9.3 million within our secure modern workplace solutions was really a great outcome, considering we didn't have much of that project work in the period. You'll see there as well within our global business a bit of an increase, and then we saw a little bit of a decrease in our domestic communications and collaboration business. We've had a bit of a look at that. What we've seen is that for our top end of our customers, say our top 20, top 50 customers, we actually saw an increase in revenue, which was a great thing. A lot of this decrease is at the bottom end of the market, which is the end of the market that we're not really focusing on. But we saw, some great increases in our larger customers. Also, some further cross-sell of secure modern workplace solutions, which was really positive. In terms of our gross profit, we grew that in the half, which was a great outcome. And just an update that we've included in this pack, you'll see that our global gross profit. Now, by the way, this does eliminate intercompany margin. And so that margin really flows into, if you like, the end retail units, because the global business does provide services and core products to a couple of our other retail-facing units domestically, but our global gross margin went to 3.3 million versus 3 million previously, which was a really great outcome in the period. And then our secure modern workplace solutions was up a little bit. Our cloud comms and collaboration was down a little bit. But all in all, we saw an increase across the board with our gross profit, which we were really happy with. You see the EBITDAs per business unit as well, really impacted the overall by the increase of 0.8 million versus the previous corresponding period with that investment we made within our global business. Cash flow position, the underlying cash flow position when we adjust for that delayed debtor payment was still very strong. So we've got positive operating cash flows. Very low level of capex within our business, which is a feature of our business, and hence a positive free cash flow as well. In terms of the balance sheet, cash on hand at 31 December was 2.7 million. Our term loan, we continue to pay that down. That's now down to 7 million. We did declare a dividend, as I mentioned earlier as well. And we have paid a dividend of 0.9 million in September 24, which came into our cash flow results in the period. In terms of strategy and outlook, we summarise our strategy and outlook here. We continue to have a strong focus on the corporate mid-market sector domestically. We're keen to see if we can grow that business, and that potentially could be via strategic growth options. Also, a cross-sell of our IT solutions, if you like. And security is obviously a key thing. So secure modern workplace solutions, which our customers are very happy with, selling that to our wider customer base of circa 5,000 customers. Our partner program in general, and then our strategic accounts, looking to continue to grow those. A number of those key deals that we closed in the first half were from these strategic accounts, and we're seeing further momentum there. So really happy with how that's tracking to date. And some of the resources that we've added within our global is really to reinforce our position with those particular accounts. We did leverage our significant Asia Pacific footprint to provide unified comms. We want to do more of that, and we're looking to introduce a number of programs so we can sell into that footprint, which is a key differentiation versus our competitors domestically. Continuing to transform the business, we expect to see some further cost reductions through that transformation. But an overall strategy, we want to increase our operating and free cash flow generation, improve shareholder returns. And the other thing we are looking at doing is strategic growth opportunities to increase our scale. We have got a certain level of fixed cost, and if we can distribute that over a larger business, we should be able to get increasing returns for shareholders. In terms of group outlook, we're looking at a revenue in the range of 55 to 57, and our underlying EBITDA target of 5 to 6 million. We're still expecting a solid cash flow position for the year, and as mentioned, we're exploring strategic growth opportunities. Mark, I think I'll hand over to you for any questions. I've got through that pretty quickly so that there's some time for questions from those attending today.
Yeah, cheers. Thanks, Peter. Maybe just one quickly on capital allocation more broadly. I see now you've done the interim dividend. You talked about paying down debt. So, should we expect that kind of cadence now of an interim and a final to kind of continue on? Do you want to get the debt down to zero and you want to get there as quickly as possible, or are you happy just as the monthly repayments or quarterly repayments, whatever the cycle is comes, you just kind of keep chipping away ahead over time? Maybe just how the board is thinking on all of those different, I guess, capital allocation demands.
Sure.
Like that.
Sure. Look, we've declared an interim dividend on this occasion. We're keen to continue to look at dividends for shareholders, so that's one priority. And obviously, we look at the cash that's available within the business. We need to keep a cash buffer, for working capital and the like. And we have increased our debt repayment. I think we're at around about 300K per quarter now. And so, we're getting a good level of principal repayment within the business that we're comfortable with as a board, plus some return to shareholders. So yes, we need to work to get that balance right. That's something that the board looks at, and then obviously potential for strategic growth opportunities as well. So at this stage, though, if you look at various parts of our business, we are generating some good returns, gross margins around the 50%. And so, we want to give some returns to our shareholders as part of that.
Just on we take the three businesses, not the four, the three businesses. I just want to delve into, customer concentration risk, or is it a risk in any of those three businesses? Is there one 20%, 30% customer within any one of those segments, or is it, we deal with some kind of large customers, but none of them is a huge whale compared to kind of what you're dealing with the rest of them?
Yeah, look, I think in general across our businesses today, we don't have any single customer that accounts for a large proportion of the revenue. And we have a number of key customers within global, but nothing like the 20% level that you've alluded to. So I think at this stage we've got a very good mix of customers, and we're continuing to expand, the number of customers that we have. Within our other two businesses as well, I think we've got a good balance of customers, and not a lot of risk there in terms of customer concentration.
Just on the Asia business, I know I don't think it was the last time you were on here. I think it was the time before you were on when a lot of the licensing and regulation had kind of finally come through, and you were pretty excited about what that could give you in terms of opening up conversations now that you're fully regulated within those markets. Has that actually kind of borne itself through now? Are you seeing? I appreciate it's still kind of enterprise.
Yeah, no, we most definitely are. And look, due to some of the confidentiality with our key customers, we can't go into any specifics as such. But with a couple of our key strategic accounts, we are now starting to see some great wins across the region. And there's a number of countries in particular. There's 3 or 4 key countries across Asia Pacific, where we're firstly a very reliable provider because we do put our own infrastructure in that country in terms of the node, which we run globally and from a central location in Australia. So we're getting deals with multinationals typically on behalf of these large carriers who are coming to us as a trusted provider. So look, it's been a great strategy, and we have circa 10 or more countries across Asia now that we can offer to these larger global carriers, and also it's very difficult for them to be in region. So we see that as a further growth opportunity for us as we go to additional large carriers who are wanting those services. I alluded to before the types of services that we're selling. Typically, that is a SIP service where we will provide local voice services over the top of that, digital voice services within market. But also we're seeing unified commerce services such as Microsoft Teams calling for these bigger providers as well. And we do get our fair share of enterprises who come to us. They can see our reach, and they're keen to do the business with us directly as well.
Yeah. And I know margin, ticked up over the half, even though revenue was kind of flat. Is that due to more product mix changes, within the different categories, or is it, stuff you're doing internally to, enhance efficiency, or is it a combination of the two?
Yeah, look, it's probably a combination of the two. We do sell a balance, or a mixture of different products, and some of those products have lower margins, some of those have higher margins. The voice products in general, or the unified comms products in general, have very high margins. So, they're a great product set for us. But also we're focusing on, being efficient and lowering our costs where we can. In a market where costs are going up, but we're still focusing very heavily on our suppliers and managing that appropriately. So yeah, we were really happy with that position in the first half to see our margin tick up further. We have got some other programs that we're working on where we believe we can even take some further costs out of the business. So we're excited about that as well.
Okay. And I don't think it would impact your business, but maybe in some of these lesser developed markets in Asia, we've seen Microsoft are shutting down Skype as a product feature within them, and I wouldn't think there'd be many businesses using it. But does that just further, I guess, enhance the case for using a proper voice system and unified comm system, for you'd say, even Microsoft is moving away from these standalone products?
No, you're right. So Microsoft has made a decision to basically close down Skype. So there is a product called Skype for Business out there that businesses do use, and it does connect into the public switch telephone network. But Microsoft has made an active decision to move all that to Teams calling. And we provide those services across the region. In general, the Asia Pacific market is a slower adopter of these new technologies. Maybe Singapore's not as slow, but most of the other countries are. We're targeting predominantly the multinational corporates, the large corporates from Europe and America, who come to us typically via their carrier, and they want the latest generation products. So we're still seeing, they're wanting to take on the latest generation products. That could be a SIP service where they plug that into their own existing PABX, or it could be a unified communications, which is totally in the cloud, which runs, effectively via an app on their laptop or on their iPhone. And it gives them that local telephone number within that market, whether that's, say, Philippines, Indonesia, Singapore, etc. So we're still seeing that adoption, but a lot of the MNCs in general will not run their businesses on some of these cheaper services. Security is critically important for them. So they're going for the standard products, the leaders from the UCaaS space, whether that's a Microsoft, Cisco WebEx, a Ring Central, etc. And we're a key provider of a number of those products today.
Okay. And, we've started to see inflation moderating, interest rate cuts, kind of happening globally. Australia finally coming to the party there. In general sense, you operate across, multiple markets. Have you noticed a change in terms of the business conditions, business environment? It kind of felt like the last 2 years, kind of post-COVID, is like everybody was very hunkered down, very cost focused. Like, are people, kind of back into, spending money on projects? We can't delay this any longer. We have to kind of upgrade now. We've kind of been on pause for, the last 2 years.
Yes, I think that's a good observation. We did get one commentary from an investor on our results that, a lot of the stuff we're providing, businesses were looking to do this 5 years ago. That's not really the case. The global multinationals are now only starting to adopt unified comms across their global footprint. Previously, it was too hard. They typically were locked into arrangements with local carriers, local telcos. And I think COVID, a lot of them did hunker down. If you think of places like Singapore, which is a regional HQ, even Sydney, a lot of the execs went back to their home country, and the businesses, were operating remotely. But at the same time, they didn't make that change to their office environment across the region. They are doing that now, and we're seeing a lot of big global multinationals, whether that's from Europe or from US, they're coming out and saying we now need to move to a unified solution for the way that our staff communicate with customers and suppliers and internally. And so they're jumping on the UCaaS bandwagon and rolling these services out. So yeah, we're seeing that now, definitely more than what we saw during the COVID period.
Great. And I'm sure those, like anything else, takes a while. Still enterprise sales.
Yes.
So,
Yes.
but yeah, at least the mindset has shifted, and the ball is in motion. It's just a matter of time then of getting this.
No, that's true. And look, one observation I would make, Mark, is that it does take time. When you're dealing with an MNC, we signed a couple of very large deals with global brand names. They were via a couple of our partners, and we're providing the large proportion of the services there. But you don't instantly turn them on. And it takes a number of months. It can take 3-4 months before you actually start to roll out their services. And that's a combination of them getting their project together and also working with the local carriers. So there is a bit of a delay between winning the contract and then rolling out the services.
Yeah, no, exactly. Peter, we're exactly on time. We'll leave it there. Thank you very much for joining us this morning. And we'll hopefully touch base later in 2025.
Okay, thank you very much.
Thanks, Peter. And we'll move to our final presenter of the morning. I'm delighted to welcome back Adam Cadwallader from Motio. Adam, good morning.
Good morning, Mark. How are you, mate?
I am good. If you want to start sharing your screen,
I will do that. Yes.
Pops up.
Sure can. How's that look?
It's just loading now, Adam. Yeah, I can see the cover slide now.
Terrific.
Two big logos to get us started with.
All right. Well, this is the favourite slide of the day, the disclaimer. But yes, I'm very happy to kick off if you like, Mark.
Yep, go ahead.
Okay. Look, certainly for the most part, this is a presentation that I gave to our shareholders last week. The agenda, very straightforward. I'll begin with a bit of a rundown of Motio, what we do, go through the highlights of the H1 results, and last week for the Coffee Microcaps result thing, talk a little bit about our recent divestment of our software business Sports, which has been acquired by essentially a management buyout, so the team that work on it here at Motio. And finally, a snapshot of the outlook for the rest of the financial year, and hopefully take some questions. So look, a bit about Motio, where it's an amazing company that we've spent the last 5 years building. We've done one cap raise in September of 2020. We're cash flow positive. We've got a healthy bank balance and a solid outlook. We're a media company, a digital publisher that continues to essentially redefine how brands connect with audiences in these places. So we're doing this through digital displays in specific locations, which form unique digital place-based networks. So the Motio network offers really the best elements of out-of-home or outdoor advertising, as we might know it, digital and video as kind of we know in sort of those online channels. The network is made up of 4 dedicated digital display channels, and all of those display channels carry dynamic, really engaging, hyper-relevant content. Each of the channel has a sort of a baseline of 100 pieces of news that comes through each day. Many of you might have seen it in a cafe or a medical center or what have you, but I'll get to that in a moment. And then obviously we layer up different editorial in each channel, in each of these across the network to make sure that the audiences are engaged, so the place and intent that is decided. So we've got this capability now to scale and expand these networks either within current verticals, so make our current channels bigger, or finding new ones, which we're always really on the hunt for. Each channel is really tailored to maximize the natural high dwell times of its environment, so where our audiences engage with us. And when we're evaluating new channels, new businesses, we're really looking for those natural high dwell time locations that we can engage. So essentially, we own and operate these channels in all of these great environments, and our revenue is generated by selling advertising and integrated campaigns on the displays, as I was just mentioning, such as major medical centres, such as the one that you see on the screen here. And I guess if I can use this example, our medical centre channel targets a huge number of people engaged in their health journey. The health channel reaches around 1 in every 4 people that visit a GP in Australia. As part of this, we've got particular audiences that are, I guess, are more frequent users. So brands look to us to communicate to these audiences, and such as women potentially on their pregnancy journey. So women that are considering pregnancy, are pregnant or have given birth, will actually attend a medical centre almost 16 times per year in that journey, and with an average dwell time of about 25 minutes. Parents with kids is another huge user of these environments, and almost 1 in every 2 of them, those parents head off to a supermarket or a pharmacy straight after visiting. That's also incredibly attractive to brands to, I guess, engage with them in things like over-the-counter pharmaceuticals, as an example. Older Australians is a bit of a no-brainer, but a very high user group. The 60 to 75-year-old group engage in sort of regular health maintenance. This group's got a really high disposable income, and they're often sort of in readiness to consider high value purchases. And that can even include things like aged care and retirement living decisions. So these are big audiences. Of course, we all visit the medical centre, but these are the major audience groups that that brands see Motio as a driver for their consideration. And again, this natural organic driver to mobile search while people are sitting in these long dwell time environments. Motio also operates displays in these gorgeous cafes in CBDs and key urban areas, which target metro professionals and show particular precision at reaching small business operators that use the cafe as their third space. So whether they're away from the office or working from home, this is a great place that they head to. And of course, we reach the metro executive market with this, which really lends itself to different brands, but certainly the travel sector especially. The next channel is our indoor sports and leisure channel. It's called Motio Play. So it's where audiences play for fun. So indoor soccer, indoor cricket, indoor netball, basketball, swimming centres. This is all about grassroots community sport and community engagement. It's incredibly unique, and it's an exciting location for brands to communicate with, really active Australians through our very, very unique platform, as I'm saying, with a combination of advertising, editorial, but also we enable our commercial partners, the centres, the medical centres, to actually put their own communication on the display. So it makes them an integral part of these locations. And certainly everyone's favourite here at Motio is Motio Venue, which operates in bars and pubs across Australia. These environments don't really need an introduction, I guess, but they do have different parts of the day that brands connect with people and varying consumer groups and behaviours. So from what we call lunchtime legends to the tradie boardroom and the after work drinks versus the late night warriors, they can be very different audiences that brands talk to in different ways. So different brands can integrate into these environments at different times, I think is, I guess, my point. So it's actually a brilliant channel that sits in this sort of 18+ environment, which is more and more difficult to manage with true brand safety. And that's something that we do offer. So the Motio network overall has got about 1,500 state-of-the-art digital displays, which is growing. We've got about 1,000 high-value locations which form up these channels. Each channel has contextualized editorials, I mentioned, and it's designed specifically for the environment, so it's not just advertising. All of the channels are underpinned by first-party data sets and location intelligence technology, and it really delivers brands this sort of maximum return to get this organic search, which essentially is something that we can do uniquely away from digital platforms. I think we've got unique characteristics. These enable brands to tell their stories to people when they're naturally engaged in these long 12-time environments. And I think, my personal sort of take on it when I'm speaking to people is like about blending storytelling, the power of video and the immediacy of digital. And of course, we like to consider ourselves a place-based out of home, so which is highly effective, and the precision of contextual placement. So I guess Motio is a platform that we talk about it not just being seen, but being remembered. But people remember things in nostalgia. So when things happen to them, that's when they can kind of connect with those moments. I'll just quickly move on to the half-one results. As I mentioned last week, we announced probably our best first half since we started what is now Motio about 4 years ago. Whilst we're still growing, revenue is up significantly, so just shy of 5.3. So following Peter's great presentation just now, we feel quite small, but up 44% for the half based on the previous half, and cash EBITDA, which is something we are, I guess, internally driven by, just a fraction over $1 million. So, and it's an exceptional result for us. And I should point out that this is a true cash EBITDA, and it's got things like rent included in it, so not removed from it to give some sort of inflated number. I can tell you that the team are really proud to be able to produce this result, certainly for our investors, and we're always looking for new investors. And we've been working towards this goal for, almost to the day over the last 4 years. So it is incredulous to say, but up 839% based on the prior corresponding period of H1 24. So we have a number of sales channels in our business. So while we're a media business, we have multiple sales channels. So the first one's local advertising. So this is local businesses buying advertising in 1 to 2 locations for a 12-month renewable period. We have national advertisers, so the big brands, it's the largest segment. They're buying campaigns from 2 weeks to sort of 2 months across our channels. Direct, and these types of advertisers are usually really large advertisers, but not necessarily large enough for an advertising agency, and they buy similarly to national, so 2 weeks to 2 months. And then programmatic, which is something I've been excited about for many years. I think the excitement has been that media is being bought and sold via online platforms. So it's the way that big business buys online advertising. We're doing the same thing in our sector. It's really begun to increase the level of automation in our business. It's still off a low base, but we've seen a significant increase across all of our channels in programmatic. The best way to describe it is a little bit the same way as we would maybe book a hotel today through a what if kind of platform versus how we might have done it 10 years ago, which is ring the hotel directly, etc. This, of course, leads me to our sports business that I mentioned at the opening. As you may already know, the week before last, we announced the divestment of the sports software platform. It's a great platform, but we've had a management buyout offer for an all-cash consideration of 1.35 million. We acquired the business about 3 years ago, and look, it's been great, but it probably hasn't done exactly what we had planned. This deal will enable Motio to focus on its core of media, improve the balance sheet, and of course, pay down some of our debt. I'll break down the sports revenue and cash EBITDA contribution in a moment, but it's fair to say the results that we got for the first half was great. As you can clearly see on the right-hand chart, the national agency revenue stream Q1 was the driver. That's what got us to this incredible result. We hit it out of the park in the first quarter. We came into the first quarter, the July quarter, very strong, and Q2, whilst it wasn't the fireball of Q1, it also yielded fantastic results, and it placed us nearly $400,000 over what we intended to be our cash EBITDA for the half. And we called that up from $1 million to 1.2 towards the end of last year. So, you know, a big deal for us. And as I just mentioned, the sale of sports has meant that we've left our full year EBITDA guidance of $1.2 million in place, as I just mentioned, which we called up last year. So just a quick minute just to kind of explain myself on this, what the sports divestment will mean to our business, or demystifying it. The sports revenue was up just shy of $60,000 for the half, so to $658,000, and its cash EBITDA contribution was $131,000, or about 13% of the total EBITDA. Obviously, the remainder of the business achieved the $870,000, which is kind of what we're keeping in place, and then we believe that we're going to have a reasonable half in the second half as well. Hope if we could do the blinder we did in the first half, it would be fantastic. I think beyond the great revenue result, gross profit was up 3%. Now, that's sort of doesn't seem like a lot in a small business like ours, but for those of you who have seen my Coffee Microcaps show before, you'll know that we've been talking about sustainable cost reduction in the cost of sales options. So through better pricing on connectivity and content management systems, which we were able to achieve, and we've seen the flow through of that. Our personnel expenses were up a little bit, mainly because of our blinder in Q1. We have to pay out some great sales commissions, which I love doing. We had slightly higher R&M costs. Most of our other expenses have been reduced and in line. We've also reduced our debtor days from 76 to 55. So we've really got the business humming and in a great shape. Net loss, clearly non-cash items driving this, and cash in bank has also significantly improved to a little over $2 million in the bank. Look, we feel very optimistic about the future, and you know, certainly there's a lot of things happening in the market that's exciting. As I just mentioned, divesting sports has been a quality strategic shift that's happened relatively quickly. The change is clearly going to enable us to focus on media. Of course, strengthening the balance sheet. I've been very positive about forward revenue. The team are really building towards that momentum. There's been some questions which I thought I might pop in here today about, you know, is our revenue recurring? Well, certainly in the software business it is. We have long-term contracts with our local advertisers, but for the most case, our business is a campaign-based revenue business. So the team are building towards what I think is the same momentum that we had last year. I'm optimistic about that future and momentum. I've been speaking a little bit about this in sort of industry forums recently, but I generally think the federal election may create some level of uncertainty across business generally, but I think there's genuine optimism, certainly from our side. What also has been driving our great results is our team has matured, the market has matured, people have, know who we are, our brand, they trust us. And, it's been a pretty exciting few years. I think we are continuing to assess some really great accretive non-organic opportunities, and big and small, that can be achieved probably with a higher share price. And look, our new revenue guidance exports will now change from 8.4 to 8.8, but cash EBITDA remains in that 1.2 plus range. So probably I love this because I get to talk about Motio a bit better. But we've actually got a really great team in place. We've got really outstanding domain knowledge. I've personally spent 30 years in media. This is my 25th year in the outdoor advertising sector, if you like. So 20 of those years have been spent working with oOh!media, for the most part, on most of these businesses that we've sort of slowly acquired in different places. I've said it twice already, but the sports completion, our balance sheet's going to be strengthened. That's exciting. We're continuing to innovate in the sector. We're actually creating incredible economic activity for ourselves, our advertisers, but importantly, the places that we go and operate within. So the medical centres, the cafes, the pubs, and the indoor sporting centres. We're creating economic activity for those partners by enabling them to have space on our displays, lending our technology to them so they can promote their own business on our displays, which has really sort of glued us in, made us really sticky to those locations. And look, hopefully off the back of this result, we'll see some market value of Motio sort of differently. I think we closed yesterday at sub 1x revenue. So I think it's, exceptional value. And as always, we are constantly increasing our revenue, our profitability, our efficiency, our cash flow. These are really core drivers to our business. And we've done all of this without burning shareholder money. So we're ready and capable of moving further and faster. So I guess a nice short presentation, Mark, but H1 results have been great. We've got great forward revenue. Our revenue per location continues to grow. So what that means for us is when we, my cost is about $5,000 to put to stand up a location, where we're looking to get that return back in 1 year or less. So, that's, we judge a lot of our movement on revenue per location. So that's continuing to grow. Our cash in bank is solid. It will be strengthened, of course. There's much more to do. There's much more to expand and look for new and better opportunities. So I think we can move further and faster this year than possibly we ever have. So it's an exciting time. Look, I appreciate this opportunity, and it's great to have you joining today. Apologies for Peter for dropping in on his presentation prior, but I'm happy to take any questions at all.
No problem at all. Adam, we got 2 questions here. And then I jotted down a few while you were talking there. Sorry, another one just come in there. So let's just get through these ones. What is your view on inorganic growth? Acquiring screens in gyms, hotels, elevators, any other locations, as opposed, and if that was the case, how would you fund that? Is it money you're going to get in there, capital bank taking on more debt, maybe?
So in terms of acquisitive growth or inorganic growth, there's opportunity out there, big and small. If we found the perfectly right acquisition, and we could get the share price into the right place, we potentially would do a capital raise to acquire something that's larger. In terms of smaller opportunities, I think we can do that with either through cash and scrip. And I think there's an enormous amount of opportunity in sort of organic opportunities, building out our current networks, and we would fund that through our cash reserves.
Okay.
Does that answer your question, Mark?
Yep. This is one on guidance, is EBITDA of 1.2, but you did 1 in the first half. People are saying that is low, but I think,
yeah.
is that just a function of Q1 knocked it out of the park. Q2 it kind of died off a bit hand, as you alluded to in the thing. The federal
Well, I think
election coming up.
So firstly, we usually carry a soft budget in Q1, right? It's usually our worst quarter of the year. This year was our best quarter. So it was unexpected, and it did give us a huge tailwind, which is what produced that result for the first half. So whilst it might look like we're going to do a softer second half, we're actually just probably on target for the second half. And if we can get those tailwinds to continue, then we'll certainly call it up. But we've sold sports, we've taken that money out of the 1.2. I think it's a pretty good result to be able to keep with the 1.2 to the end of the year without the sports business included. But yeah, it's a reasonable question.
Okay. Yeah, because there's another question on that, whether the 1.2 included sports or not. But it does.
So the 1.2 no longer includes sports. But certainly it did. Probably if we still had sports, we'd definitely be calling it up. But we will have it as a discontinued operation in the second half. From an accounting point of view.
Yeah. Just on sports, one of my questions was, obviously they are also a customer of most shows in their own right, advertising their software to people coming into gyms and these indoor sports centers, and people who voluntarily run social leagues because they want the stress and the hardship of doing that. How is that relationship going to change? Were they previously, because it was internal, they had a internal preferential discount, or how is that commercial relationship going to look post them exiting the Motio group, if I can say that?
So I think it's interesting, as maybe I'll just break that up a little bit. So firstly, one of the cool things about the deal is we're maintaining our umbilical cord to sports. So all of the things that were important to the media business, such as selling onto the websites, the data capability, and certainly the ability to communicate with people via the electronic direct mail lists and things like that we've got. We're maintaining, we're formalising a sales agreement, so that will be ongoing. The second thing is sports needs us to put their digital information onto our displays. We're maintaining that. We've got a formalised agreement as part of the sale process of that. In terms of sports spending with the play environment, that's never been a revenue stream. So one has never charged the other, even on or off books, so to speak. And that said, the sports business has done a really good job of covering that sector. So their business is actually starting to look outside of those sectors, in sort of those community-based environments that are trying to set up, mini leagues and lunchtime legends and those kind of things. They've got big customers that are sort of, pop up, sporting organisations that are much more outside of their sort of bricks and mortar locations. So that's probably less of an issue for them moving forward.
Yeah. And you called out, if I go back to the very start, you're potentially looking at like new verticals. I'm just wondering, what are some of the options on the table there? Is it schools and universities, or is it somewhere else? Because I was just trying to think of, where do I naturally spend 10 or 15 minutes waiting for something? Obviously, your coffee, or
I think the healthcare environment
is, they're obvious ones, but some of the other ones I was scratching my head on.
Yeah, no, I think that's right. I think the healthcare environment is really, really interesting. Whilst we're in general practice, there's an enormous amount of opportunity there. We've done a partnership just recently with another company that do wayfinding in hospitals. So there's a lot of opportunities just in healthcare alone. The retail environment is coming to life, and that's becoming really interesting. It's certainly, those companies, retailers that are looking for sales representation are looking to companies like us, because we have the ability to, turn on the tap of, monetize their assets for them in their non-endemic platforms. So endemic being their customers internally. So let's say you're a big chain of chemists, for example, you might sell that space a bit like how Chemist Warehouse have done a really fantastic job of that. But looking for external media is always an opportunity for us. There's other verticals that are probably a little bit more unseen that we are excited about. And also regional Australia is generally untapped. I think we are looking at areas such as culturally and linguistically diverse areas that I think is really exciting for brands to be able to communicate to those communities that need to be spoken to in their own language in different ways. That it's we're not just all sort of white guys from Bondi kind of thing. So we've got to be able to expand and be able to communicate better. And I think brands are becoming very good at doing that. We need to meet the market, and there's an opportunity to do so. Same within regional areas, Aboriginal, Torres Strait Islander areas that we need to improve our communication. So there's enormous amount of opportunity to digitize what is potentially static signage. I love the university sector. There's some great opportunities there, but we're also looking at different places that aren't in sort of the natural CBD everyday places that can be monetized.
And just going back to the big spike we saw in agency revenue, was that just like generally across the board, or was it one brand who has, okay, we're doing a major campaign, major push, and we've got to hit. I'm thinking they're hitting all of these verticals. They can tweak it for the bars and clubs, somebody like Coca-Cola, for example, or they can tweak it for the cafes or whatever. And just maybe give us what drove such a big thing in that agency, or was it just general? Everybody's wants to get out there, start a new financial year. Let's get off to a good start. New budgets.
So in terms of just focusing on quarter one, I think is what you're asking, what drove the quarter one. We came into the quarter, and I had done some presentations. I'd even, sat here with Coffee Microcaps and said we were ahead, like we were going to make our budget in the first 11 days of the quarter, which we did. So we had an enormous amount of opportunity and interest. It was grown off the back of the team maturing. And then we probably had a couple of brands come in late with some, maybe not big chunky amounts, but, probably half a dozen campaigns that fell in on top of what we were already over that really drove that result. So there was no one specific advertiser or sector that really drove it. I think we generally do very well with government, with healthcare, pharmaceutical, even aged care. That time of the year, is really interesting, and our health business did particularly well. So that's probably a long answer to your question, is that there wasn't a specific advertiser. It was a whole lot of advertisers that were active at the one point. And the interesting thing for us was it was at a time when the rest of the market was retracting. So we were up huge. Everybody was sort of, we go to industry events and things like that. Everyone's kind of having a bit of a kickstones moment. And we were like, no, we're fine. So we've had an exciting half, and we're continuing to have an exciting time. It's just that our first quarter was so damn good. It's hard to sort of shake it off in a way, but we can repeat it, I think is the interesting part of it. And we know what we did. We've got to make sure that we continue to do it. And we've worked out the recipe, the flavor, and the rhythm of what we need to go to market with.
Final question, take it from the audience here. Any update on Move 2.0?
Yes. So
actually the trainer, where are we?
Yeah, the team are actually in a training session on it right now. So it's getting very exciting. The industry is completely abuzz with it. To have probably what will be an entire sector being able to be measured on a single platform will be fantastic for advertisers. It'll be fantastic for the sector. It'll be fantastic for advertising in Australia. Just generally, the world is watching us to see how this goes. I'm fortunate enough to be on the board of directors of the Outdoor Media Association. We're taking it very seriously. It's an exciting time, and I think we probably will have it in place at the end of this financial year. So we're all, as an entire industry and as an entire, I guess, not just outdoor, but the industry at large, we're very excited for it.
Yes, yeah, it's something to look forward to in FY26.
Yes, that's very exciting.
Perfect.
But yes, thank you very much for having me today, Mark. Really appreciate it.
No worries, Adam. Yeah, we have gone slightly over time just with that last one, but I wanted to squeeze it in there because it is, something we have touched on in the past, and it is as you say, industry-wide initiative. It's not, just unique to Motio. And we will leave it there for this morning. Just a reminder for everyone who's still with us, we've got 5 more companies presenting tomorrow morning, so please do join us for our session tomorrow morning. And with that, I wish everybody a good rest of their Thursday. Thank you.